Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This week, we're joined by Ron Kahn, longtime friend and managing director at Lincoln International and responsible for their valuations practice there. Ron, it is fabulous having you here.
I am thrilled to be here with you, Randy. We've gone way back for a long time.
And between the two of us, I think we can solve a lot of problems today.
Or create some.
Or create some. So, first of all, just by way of introduction for Lincoln International, one of the leading middle market investment banks in the country, and also, frankly, responsible for a lot of thought leadership on private markets, particularly your private market index, which has been really terrific, portfolio of thousands of companies and tracking their performance, valuations, and so forth. So we'll talk about that as well. Maybe I can just start by having you help us through this really amazing, and we're talking in kind of, March 21st, 2024, and looking at where the markets are carrying us, public markets, feeling really good about the Fed continuing to see growth in the economy. Inflation, while sticky, is seemingly coming down, and they seem to be still on track to cut rates at least 3 times sometime during the year. They didn't tell us when, but what's your take about what's going on?
Well, the one thing that's interesting is M&A activity continues to be lackluster, and many people in private equity, private credit, we all interpolate that to what's going on in the economy, which is not really accurate because we're not doing as many deals. Well, maybe things aren't so good, but they are really good. As you pointed out, we value, let's call it 5,000 portfolio companies every quarter. And we saw growth in 23 versus 22, EBITDA growth 4.8%. That's pretty robust. And I think we're continuing to see that right now. Stock market's probably just a function of people anticipating the lower interest rates, and so that money switching from bonds to stocks, and you see the uplift. But overall, we're seeing the economy doing in pretty good shape.
So we'll talk about growth in a minute, and your tracking of that for private companies is really critical because, one of the challenges in private markets is it's private. These aren't public companies. It's hard to track, and your index provides some real transparency to that. So the Lincoln Private Market Index increased by 0.6% for the fourth quarter. Talk about what that index is and why it's so significant.
So we established the index in 2016 in conjunction with Steve Kaplan, who is probably the most well-known academic in private equity. He's at the University of Chicago Booth School of Business. He's actually helped by 2 other professors, Mike Minnis and Pietro Veronesi. I'll make a long story short because some people might get a kick out of it. The index got formed by accident. It was 2016, and believe it or not, in 2016, there was no cloud. Things were still, all the data was maintained on a server. And so we had this meeting, and I'm not too sure even what the genesis of the meeting was, but I know the head of IT was there, the head of the firm was there, and the head of IT was like, "You guys are killing me. The valuation practice is growing so rapidly, and you get so much information on each portfolio company. I have to go out and buy new servers every quarter. Like, can we just get rid of this information?" And the chairman of the board, Jim Lawson, said, "No, are you kidding? You got gold there. No, we need to use this, and we should create an index."
Yeah.
And I was like, "An index?
Yeah.
Jim, this is way above my capability." He says, "Well, we're a mile from the University of Chicago. The smartest minds in the country are there. Go down and talk to them." So I reached out to Steve Kaplan thinking he's never going to respond. I painstakingly put this email together on a Saturday morning. I'll never forget it, telling him what we wanted to do. We pushed send. Literally 10 minutes, he said, "Come down to campus." So what it basically is, I think the first ever index of the enterprise value for private equity owned companies. Right now, the constituents go up to close to 5,000. There's some secret sauce of what goes in and what goes out of the index. But not only are we able to measure just the overall index, but we're able to segregate it by how much of the index's increase or decreases based on performance and how much is based on market multiples. And I think the one thing that we've been really surprised at is the indexes for private companies, private equity owned companies, are basically moving based on fundamentals as opposed to the S&P 500, which we often compare it to, which is more affected by changes in multiples.
Right, which is fundamental to the understanding of public versus private, right? And we talk about a lot of this in the lead left and with private capital call, trying to get investors and frankly market participants to understand the difference between valuations based on actual performance versus those based on market multiples, which often are generated in the public market by sentiment, driven by rates and expectations of economic outlooks and other exogenous and sometimes headline factors that may or may not stick around. So if you think about the enterprise value, which you say is the calculation is a bit of a black box and there's some things going into that, and we saw continued increases, what does that say about the outlook for 2024?
It's very positive. I think that the one thing that, and there's been some concerns about valuations, and I think the one thing that you find out consistently as you look at the index compared to the S&P is the private companies are way less volatile. At the end of, so we've been doing this since 2016, so here we are close to 8 years later. They're almost on top of each other at the end of the day. But when you look at the S&P, the volatility going up and down, and the LPMI just kind of like keeps going up
Steady.
without having kneeling the volatility, which goes to your point about liquidity. You don't have liquidity issues in the private markets that you do in the public markets, which has a lot of effect on valuations.
So let's talk about valuations a little bit more. The valuations in sort of, let's call it private equity, which are typically kind of multiples of EBITDA, multiples of cash flow. If you think about before the rates started going up, you had, I think, 13.4 times multiple in your Lincoln Index for observed multiples for private companies. Where is that multiple today, and what's behind the change?
On actual deals that are happening, it's come down between 1.5 and 2 times. I think it's right around 11 and change.
11.8.
Something like that. On obviously a lot fewer deals. So you could make an argument that maybe that 11, you say 8, is a little bit overstated because in general, because it skews towards only the deals that are going on today, which are better deals. Why does it come down? It's a SOFR issue. I always call it just a math issue.
Because SOFR, which is the benchmark, which is now 5.5, 5.25, 5.5, and it was 0 not that long ago.
0. People had a 1% floor. Remember floors?
Yes.
That seems like a long time ago.
And so if you look at, and you have obviously a significant debt capital practice at Lincoln, and you look at financing costs, which I assume is a big mover in terms of valuation, because if a private equity sponsor is looking to buy a business, they're typically looking to finance a significant part of that. And it's harder to finance with more debt if the debt is more costly. And today, it's a 12% coupon, give or take, for senior debt versus a 7% coupon before the Fed took hold of rates. And so I assume that is going to make it harder to spend more for businesses.
Sure. So you're a buyer. You want to buy a company. You were, before all this started, certainly able to do 40% debt to equity. It probably went up to 50%, maybe even 55%. The competitive environment lately maybe is pushing that down. But to your point, whatever debt they get is almost twice the cost. And so you have a choice as a buyer. You either can accept a lower IRR on a new deal, which is not very palatable, or you can convince the seller that he's got to come down in price, which is they're not really necessarily willing to do this. And that's why you have this standstill between buyer and seller. I think we're old enough to know that it's normally the seller that blinks, not the buyer, because the person who has the money controls the game.
Right.
And so I think you're starting to see a few more deals where limited partners are putting pressure on these GPs saying, we need some money back. We need some distribution. Certainly, if you want to raise another fund, you got to get us some distribution. And so you're starting to see some of these sellers give in on price. But the interesting thing is when you do an LBO model, if you bought a company back in 2021, whatever, at pick a number, 15, 16, 17, and now you're selling it at 2 times less multiple, even if that company had decent growth, you're not
Mhm.
going to get a very good
Yeah.
IRR, and IRR is the lifeblood of private equity.
So we'll talk about distributions in a second, but just going back to that issue in terms of M&A. So you have owners of properties who bought during the zero rate environment, right? And with the best financing terms available, now they're looking to sell them in a more challenging environment. So we have year after the last several years in during this first quarter period have interviewed the Lincolns of the world in the U.S. and their response has been, it's coming. The flow is coming. We see a record number of books. Our lawyers are really busy working up our disclosure letters and so forth, and it doesn't come. Do you think we're in for another year of disappointment, or do you think maybe this is going to be the year when there's going to be a breakthrough?
So we did a survey of lenders. Probably there were 250 people that participated, and roughly, I think 2/3 thought it was going to happen in the next 6 months. Will it? I'm a little bit more skeptical. I don't think the math issue is going to go away because even if the Fed does cut rates 3 times, 75 basis point, it doesn't really move the needle that much in terms of fixed charge coverage and debt capacity. So I think you still have that issue. And I think LPs are going to hold on, GPs are going to hold on as
Mhm.
long as they possibly can and hope that they can get that better multiple, get a better IRR, and raise another fund. I will tell you this, that on the M&A side, I think our backlog of deals may be higher than
Mm.
ever because we go out, we make a pitch, we win the assignment, we get ready, we prepare everything, and people say, no, hold. It's just not the right time. So the backlog continues, and at some point, they're going to unleash a tsunami of deals.
Yeah.
But when that's going to come is kind of anybody's guess.
And I think part of the sentiment, and you're certainly seeing it in the public markets, is that the worst is over and that the Fed, whether it's 3 cuts or when it comes, that the direction is down. And so that expectations are you can, and even frankly in the public credit markets this year, you've seen significantly higher levels of certainly refinancings, taking out some of the more expensive private capital debt that was raised during the period when public debt was not available. And which is a natural swing of the pendulum. We always see that in a little bit more frothy times because the public credit markets tend to be cheaper. I mean, leverage for CLOs is higher. It allows for an L plus 350, L plus 400 spread for some of the upper middle market, more liquid deals. But I think that directionally, this sense of confidence in the ability to finance deals will probably gain some steam if, in fact, in June, which is, I think, when people are expecting the first cut, if that actually happens, even 25 basis points, 50 basis points does help in terms of the amount, the increment of debt that you can add to these businesses.
Every little bit helps. And it's not only now, obviously, the decrease in SOFR, but we are seeing decrease in spreads.
Talk about that. How because you have a financing business. What are you seeing? What's a typical middle market, senior deal costing these
I
days?
think it's phenomenal because in a period from, I'm going to say, December 15th to January 15th, January 31st, spreads came down by good 25, 50, and sometimes 75 basis points. And I think a lot of that has to do with the BSL market, the broadly syndicated
Yep.
market coming back, which is now an attractive alternative to private credit for the right types of transactions. As we talked about, there's not a lot of new acquisition financing, so there has been so much money raised in private credit. It needs to be deployed. It used to not have a BSL market to compete with. Now it does. And so we've seen people become more competitive and bring down spreads.
Right. And of course, the spread compression always gets the headlines, which
That
annoys me to no end because there were no headlines over the last 2 years when private credit spreads were going up as the benchmark went up, which is somewhat surprising because in 2006 and 7, when the benchmark was going up, as you recall, and it peaked in June of 2007 at 5.5%, spreads were coming down in the broadly syndicated market. Why? Because the sponsors were saying, hey, my total cost of capital back in 2005 or whatever was 8%. I'd like it to stay close to that, please. And the bankers basically went to the market and said we need to keep the costs down, and that is in fact what happened. But in the private market, it's a very different ballgame, isn't it, in terms of the supply demand?
Well, the one thing that is a discipline on private credit is they have promised their investors a certain minimum return.
Hmm.
And in order to get that return, their pricing probably needs to be a little bit higher. Certainly in the BSL, there's a limit to how far down they can go. I mean, at one time that was probably 8 to 10 before SOFR went up. Today it's probably in the 10, maybe 11%.
Right.
And so they don't have a choice but to put money out at that rate in order to appease their investors. As SOFR comes down, there's more competition, though. They're going to have to continue to decrease the pricing in order to get money to put money out.
So let's talk about the impact on the portfolio companies, because you track that as well in terms of, and this is investors ask this all the time, pressures on interest coverage ratios, fixed charge coverage ratios. What do your statistics generally show with regard to that?
The first thing I think is interesting is these companies are resilient in terms of earnings. I think I mentioned 4.8% increase in EBITDA year over year. They're healthy. They're doing quite well, but they are suffering from higher SOFR, higher interest costs, lower fixed charge coverage. And so there's issues. Surprisingly, we keep a default. We also have a default index. The default rate is covenant, based on covenants, not necessarily payment defaults, and it's size weighted. And over the last couple of quarters, we've actually seen it decline.
Hmm.
I was like, decline? When we first saw that statistic, I was like, this can't be right. Go
Right.
back to the drawing board. You screwed this up. And it turns out that of the companies we value, I think it's close to 18% have been amended in the last year. Many of them seem to be proactively amended because the sponsor and the lender say, we've got a really healthy company, everything is great, no fault of ours. SOFR's at 5.25. We cannot let this company falter. And so I think it's just a testimony to all of private credit and private equity, how they work together to proactively amend these loans. So there's some relief. Some of it's in PIK. Many times the equity sponsor is putting in additional capital to the company to pay down debt or to use it for growth. But as a result of that, I think when we do our quarterly evaluations, the number of companies that are taken over by private credit, you could probably count on one hand.
Yeah.
It just doesn't happen because they are collaborating on this with the sponsor to make sure these companies stay healthy.
Well, this is one of the many reasons I wanted you on, Ron, is because that story doesn't get out there enough. The fact that when the headlines about default rates or worries about default rates, which is really what comes out, particularly in the early part of the year when certain groups were in the media were looking at interest rates and saying there must be you got to pay the piper. And at some point, you're going to see this impacting. And they take what's going on in the public markets and they extrapolate it to the private markets. And that's just, you can't do that because the whole process that you mentioned, where the lenders and the owners, the private equity sponsors work together to fix problems, is not the same as it is in the public markets.
So one thing I think that private credit has done an incredible job in is making sure private equity puts a substantial amount of equity into every one of their portfolio companies. At a minimum, I'm not sure you can get a deal done ever in the last even 10, 15 years, less than 40%. And so when there was a problem arises, a private equity guy as opposed to back in the 80s, said, well, I was just putting in 5% equity. I can walk away. You take it. Private equity can't do that anymore. They have too much at stake where they really need to support these companies. And that really is a testament to private credit, making sure they maintain that no matter what kind of competitive environment, make sure that they maintain that discipline so that sponsors really have to come to the table and if there's a need for additional capital.
So you mentioned resilience, which is a really good word, and I use it a lot when I talk to investors about the difference between the private credit performance and certainly the portfolio performance versus some of the publics. Talk about the industries that you see, because one of the things that isn't talked about also as much is that private equity sponsors seek growthy industries where they can make a difference in businesses that have a tailwind behind them, or that there's certain dynamics to the sectors that make them appealing. Could you talk just a little bit about what you see, in the data in terms of the different industries and why these seem to be businesses that are doing well, both in terms of revenue and cash flow growth?
Private equity is very disciplined in picking companies, as you say, that are consistent, stable performers, because that's what you can put the financing on. I think over the last 2 years, the sector that's probably gotten hit the hardest is consumer. Again, not necessarily fault of private equity. It's just consumers been hurting with inflation, and so their companies are not performing as well as most of the others. We've seen softness in healthcare too, which has been surprising, but that has to do with reimbursement rate.
Yep.
It has to do with labor. Again, I don't think anybody could foresee that. But again, sponsors and private credit doing what they need to do to make sure that these companies continue.
And in lieu of M&A activity, which we hope will pick up, it does feel, and this is true in our own portfolio and with our clients, our sponsor clients, that the number of acquisitions, the add-ons to these portfolios is increasing in lieu of sometimes organic growth, but certainly the desire to improve both those revenues and EBITDA performances. And I think your data reflects increased
Absolutely.
activity in add-ons.
The number of add-ons we see versus platforms and even refinancing has gone up substantially. And it does a couple of things. It does add growth, and it also brings down the multiple, because normally the add-on is going to be at a less multiple than the platform. So if you bought that platform at 15, you may be able to blend down to a 14, 13, 12, which then when you do sell it in today's environment, you're not getting the multiple hit that you would have gotten had you not done all those add-ons.
Mm-hmm. You mentioned distributions. Let's talk about the investors. So, what is the dynamic, and you and I have talked about this recently in the markets, in terms of the capital that's being returned versus the capital that the investors have put into these businesses? And I know you have now a ratio that you're tracking.
Well, we don't necessarily track that ratio, but the new acronym is distributions to paid in capital, DPIC, or however you want to call it. And I think it was probably originated more by the limiteds than the GPs, in saying that they're not getting the distributions that they were expected. And if you expect us to put in more, invest more into your new fund, we have to have the distribution. So they created this ratio of what they've received as opposed to what they have invested. And I think they would like it to be closer to 1-to-1. I don't exactly know where it stands right now, but it's certainly something that limiteds are looking at and GPs are cognizant of, because they want to raise another fund.
And in lieu sometimes of realizations through sales of portfolio companies, there are other methods, there's other options for the GPs. What are some of those?
Well, you can't do dividend recaps, but you have to make sure that you're pretty low leverage in order to be able to do the dividend recap. I think the phenomenon that's been gained the more widest acceptance in the last couple of years, the continuation vehicles, which come in a lot of different shapes, sizes, flavors. We have a group within Lincoln that is doing those kind of deals. We do fairness opinions for those deals quite frequently. There's single asset deals, there are multi-asset deals. It's interesting because when continuation vehicles first started, had a negative connotation because it was a way for private equity firm to divest a poorly performing company. Now it's probably the opposite, where they take their best portfolio company and they really don't want to have to sell it because it's such a winner and maybe it's continuing to grow, and they put that in the continuation vehicle. They get money back that they can give their limiteds to handle the distribution issue, and they now have a portfolio company they can continue to grow and invest in going forward.
So Ron, as we wrap up, 20 minutes has gone by super fast. This is going to be an interesting year. We're obviously in mid-March in a really good place. Feels like a happy place for the markets. I don't know if it's the golden era of private capital, but it's definitely the Goldilocks era. Not too hot, not too cold. And you mentioned resilience. What do you think the outlook is for private capital and deal doing in general?
I think certainly for private credit, 24 and even 25 are going to be very good years. It's a very attractive asset class. It's going to continue to be attractive asset class. It's continuing to yield very, very good amounts for their investors. And again, with 4.8% growth in earnings, these companies are doing well. They, for the most part, are capitalized quite well. And so I don't see any issues in private credit. And private equity, eventually they're going to have to deploy this capital. There's a lot of pent-up demand. There's a lot of companies that need to be sold. There's a lot of capital waiting on the sideline. So I don't know whether it's going to be 6 months, 9 months, but certainly the deal flow will come back, and that'll make all of us very happy.
And Ron, there are some exogenous issues that we have to worry about. We've got actually a presidential election coming up amazingly, and there's a lot of geopolitical risk. But private capital is resilient, so I assume you share my view that whatever happens, that it's probably a pretty good place to be.
I would certainly agree with that.
Ron Kahn, Managing Director at Lincoln International and head of your valuations practice and terrific friend. Thank you so much for being
Oh,
here.
Randy, thank you. It was a real honor to be here with you.